Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. For today's episode, episode 64, we're going to talk about some dangers, hidden and not hidden, of reactive S-corporation conversions. So we'll dig into how the corporate tax landscape has changed favorably in the last few years, and how those changes could be removed, and what are some hidden dangers that lurk out there, with some real-life examples of those. Now, as always, this presentation is not intended to substitute for legal or tax advice. Now, I've been getting the question a lot lately from clients and from other attorneys and advisors and people who deal in the tax world about whether it makes sense to have a real estate entity elect to be taxed as a C corporation. And I feel like there's a lot of people who've probably done that in the last few years because of the Tax Cuts and Jobs Act of 2017. What it did is it lowered the corporate income tax rates to a maximum of 21%, which made the C corporation a more attractive option for a variety of business entities. And there may be a lot of misinformation out here on this just because of the ability to deduct and preserve losses and things of that nature, but I feel like a lot of real estate entities have made the lack of S-corp election, I should say, to make sure that they're taxed as a C corporation. Now, one problem with the C corporation traditionally is the double tax. There's an entity level income tax, which is low right now. It has a maximum 21% rate. However, after-tax income of the C corporation has to be distributed at some point to its shareholders, and when distributed, that after-tax income is treated as earnings and profits and is taxed as a dividend. Now, if it's a qualified dividend, it's subject to a long-term capital gains rate tax, or if it's not a qualified dividend, it's subject to ordinary income tax when received by the shareholder. Now, we won't get into the distinction there, but what I will mention is that for the longest time, if you've elected the corporate form of entity, or even for certain tax purposes for non-corporate form entities, you can make an election to be taxed as an association, which opens this up. But you have the availability of the S corporation election, which essentially removes the corporate level income tax and taxes all shareholders on their proportionate share of the corporate income for the year. And as a result, distributions of earnings while you are an S corporation represent income that was already taxed to the shareholders. So as a result, the act of that after-tax income being distributed to the shareholders is no longer a taxable event. Now, depending on what happens post-election, especially with tax laws, it may once again be attractive to be an S corporation and not a C corporation, especially if the corporate tax rate is increased from 21%. Now, there's too many permutations on that to get into here with types of income and different forms of planning, but one thing I do caution you on is that if you are a C corporation first for a period of time and then convert to an S corporation, there are some issues to be aware of. One is that any accumulated earnings and profits that would have been taxed as a dividend while you were a C corporation, if distributed, will continue to have that tax deferral feature. So the S corporation has to hold those earnings and profits in what's known as an accumulated adjustments account and tax those as dividends to the shareholders when distributed to that now S corporation shareholders. Another issue is the built-in gains tax. So if you have any appreciated corporate property and it's sold within 5 years of the S corporation conversion, there will be a built-in gains tax taxed at the highest corporate rate to the S corporation itself. Now, that's not a high rate right now, but the increase of the corporate rate, which seems inevitable from its current low of 21%, could adversely increase this built-in gains tax. So those are just a few things, and you also have to get into the eligibility issues, which I'm going to kind of skate over just because a lot of people already know these if they're tax practitioners. That is, for an S corporation election, you have to have 100 or fewer shareholders, who typically must be individuals, with some small exceptions we won't get into. And you also have to have one class of stock from a capital rights perspective. So you can break it down into voting and non-voting stock, but the shares of voting and non-voting stock must have the same dividend and liquidation preferences within the S corporation itself. So with those requirements and a few other things, it's easy to inadvertently terminate your S corporation election if these basic requirements are no longer met. But there's some other issues that skate under the radar, and in particular I want to call out one that relates to the conversion of a C corporation to an S corporation and what happens to your accumulated earnings and profits. And there was a recent private letter ruling, PLR 2024-0006, in which an S corporation had to distribute all of its accumulated C corporation earnings and profits, and this was done in order to avoid an inadvertent termination of its S corporation election. Now, why did this have to happen? Because there's a little-known code section which really applies in a situation where you have an old and cold C corporation that's made an S corporation election. Now, as long as that S corporation has earnings and profits in its accumulated adjustments account, you always have to look at its previous 3 years of gross receipts. And if in those 3 previous years you cross this threshold where more than 25% of the gross receipts consist of passive investment income, then the S corporation election will be terminated at that point. So passive investment income, I should say in this case, includes things like rents, in addition to interest and dividends and royalties, etc. Now, I want to emphasize rents and royalties because, going back to our intro dealing with real estate holdings, if you have an S corporation that holds real estate rentals or oil and gas interests, this inadvertent termination could be an issue, and a lot of CPAs like to caution that you should hold on to that accumulated C corporation earnings and profits so as to defer the income tax on those, but there may be a bigger cost to doing so if your passive investment income crosses that 25% threshold for 3 years in a row. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of The 10th of an Hour, and I look forward to seeing you in the next one.